Inflation update relative to the business cycle model and rich pause for critical point March 2nd, 2025. Okay, this is the CPI US monthly inflation rate month to month, not annualized, and it's updated through January. News as of last week looks as though the inflation could be coming down. And we got news that the Atlanta Fed, with their GDP now calculation, came up with a minus 1.5% for first quarter GDP, a big collapse. And that would be in recession territory, other than you need 2 quarters of minus GDP, consecutive quarters, to cause most economists to say we're probably in a recession. And not only that, the GDP now is just a speculation, and that particular indicator has been quite volatile and off the market times, but it is something to consider, and it did excite the market on Friday. So here over the weekend, the modeling is looking at the CPI inflation and saying things have turned to the negative side for the U.S. economy so quickly that my prior forecast has changed. They're going to make an official change here today. So this chart is a CPI month to month, and what I'm saying is back in 2020 had the juggler business cycle, that is the once a decade type event that relates to economic growth for 7 to 12 years, recession 1 to 3 years. And then we see it move on up as net growth, and it goes into a kitchen business cycle. And the kitchen will occur with the juggler tops and bottoms, but then it occurs a few to several times in between the juggler bottom and top, along with that decade growth. Okay, so it's a smaller fluctuation, a throttle up, throttle down process of our economy. So we can see with the 2020 or 2022 war on inflation, that it came down, and that actually is a kitchen business cycle. Well, this move right here looks like a business cycle, but the model warned it's not sufficient, it's not done. But as we move later into the year, it was saying we'll probably get a blip up, pull it down, but better get concerned of higher. Well, we got so much strength there going into the end of the year and into January. The model decided to err on the side. Something has changed here. It bottomed sooner, and go with it. And I already had made my personal call late last year to go with it and assuming it would be up, and it was a correct forecast, okay? But you may recall I warned when I had those discussions late last year that we could get pullbacks during the first half of this year and then move on to higher inflation. Well, the model is now suggesting that actually in January might be an ideal but a bit late time for a kitchen business cycle top. And looking at the data as it's flowing in here and looking how investors are getting concerned and business people are becoming concerned, I think there's a good chance that if it doesn't begin with the February inflation, it can begin by March and no later than April inflation, which means we may have to wait to May to actually see the evidence. But I think what we're going to see in the next few months here is a drop in inflation. And it could well bottom in just the next few months for that kitchen business cycle, and we learn it was just a blip, that the CPI spends most of its time moving sideways anyways, especially when it's a month-to-month measurement. But we can get clues from it at least. What I've learned, though, is this next kitchen business cycle bottom doesn't have to show up to about the end of the year, and that's what I warned you with GDP and other things. And with the stock market, I've warned that even though I'm looking for a long-term bottom in a few months, that it doesn't have to show up to like October, September for the stock market. And with GDP, it might not look good all the way to the end of the year. Well, now we can have inflation down. So what's this mean? It seems as though I ought to be optimistic and positive that, hey, we're bringing down inflation. We can have a good year. Well, the problem is, why are we bringing down inflation? That's the question answer. And what we're looking at is the economy's just slowing down, and people are getting nervous, and they're spending less. That will help bring down inflation, but the real something we need to watch more than inflation is all the other economic indicators. That when you have a recession, and we're allowed for a secondary recession 2025, 2027, I don't think we've seen one since the 1970s, even more so 1950s back in the 1800s. But I think things have reverted where we're doing things like the 1800s and even back during the Depression times, we can have a secondary recession. All it means is you get two significant recessions during a decade, but the secondary recession often slips under the radar screen of economists, and they don't make the official call. They don't call it a recession. It doesn't wind up in the history books, but it's pretty close and serious to some businesses, some people, some workers. Okay, so at any rate, this time around, I think we are vulnerable with all this tariff stuff and everything is gone on. We're vulnerable for a secondary recession, 2025 to 2027. Well, by the looks of the way things are turning, maybe it's 2025. Okay, so this lower inflation, on one hand, by itself, ought to be a positive thing. On the other hand, it can be yet another clue that there's much more going on throughout the economy that's more deflationary, disinflationary, and more like what U.S. recessions are. They're normally deflation, whereas in some countries, they're normally inflation, especially third world countries. So I'm updating you now that my official stance is I anticipate backing off on inflation, and it's not that I'm throwing out some of those scenarios of much higher inflation. I just think they're going to delay into next year, following year, and may have something to do with how the tariffs are going to develop and a delay of the response to that, and that we first got other things breaking down in our country when, in fact, instead of people betting on the high tariffs right away, they're saying, no, we want to bet on things going down in inflation and prices. Even if you raise prices from tariffs, it's just going to hurt the economy. And so they're writing a more negative stance from it. At any rate, I thought I'd give you that update that, yes, I'm calling for a setback in inflation. It's going to take a while longer before we get to more sustainable, much higher inflation. And the thing we have to watch out more so now and be more concerned of is falling into a secondary recession that's disinflation to deflation. And I don't think the stock market's going to like that. And the bond market is behaving as though it is concerned. It was playing a big inflation bet and way too much government debt bet. Well, now it's backing off in the government debt because it's assuming Trump won't allow the government to print as much money. But it's also giving up on inflation now, and it too is probably worried of a coming recession here. Now, the stock market was up on Friday just because I think some people were playing the day trading of Ukraine and U.S. and Washington, D.C., and that complication. They were playing end-of-month performance types games and end-of-week stuff. And so I think it was a little bit of just maybe bargain hunting a little bit, and the bears that were betting on the downside backed out abruptly towards the close. But it might also have been a little bit of the idea, well, if we're dropping GDP forecast and we're heading towards a recession and the bond market's already down on interest rates, is it possible it's going to pressure the Fed Reserve to lower interest rates soon? And from what I understand, the free market system's already forecasting 3 interest rates cuts this year. Well, people just assume eventually that's positive for stocks, and they'll think of it as something like a QE or something like that. They get all excited. I think they're way, way ahead of themselves. You got to have that recession starting before you actually can start saying, okay, lower interest rates will win someday, so let's go ahead and buy stocks while things are getting worse in the economy. They're just a little too early and ahead of themselves on that one. And also keep in mind the yield curve. Went inverted yield curve first time since 2022, 2023. Back then, I warned you it was signaling a recession, and I warned you do not believe people selling because of that. We were not going to get a recession. This time around, we're getting that signal, and I'm suspicious it might actually work. I will speak more of this tomorrow and throughout the week. See you tomorrow morning. Past results and not necessarily indicative future results. Have a great day. Thank you.